Hello everybody, I am Adam Grimes. Here's my contact information. You can find my blog at adamhgrimes.com/blog. My email is adamhgrimes@gmail.com, and I do try to be pretty accessible and responsive to questions. I'll answer some of those one-on-one, and I've certainly had a good number of reader questions that have led to some nice blog posts. Chances are if you have a question about something, you're probably not the only one. So if something here sparks an interest or question, please drop me a note. And you also can follow me on Twitter at Adam H. Grimes. I want to start today a series of blog and video posts looking at what I believe are some of the basic trading patterns that newer and developing traders should learn, and also some of the most useful technical patterns for more established analysts and traders, whether you use these as actual trade entries or as tools to understand evolving market structure. Doesn't really matter. These are basic patterns that are cued into fundamental principles of price behavior. So I want to start today with a shameless plug for the book. I am the author of The Art and Science of Technical Analysis, Market Structure, Price Action, and Trading Strategies. This was just released this month by Wiley, now available in bookstores and on Amazon. So if something here or in the blog sparks an interest and you would like to go into a little bit more depth, please take a look at the book. A lot of the book is readable on Amazon. You can look inside the book and I think see the first couple hundred pages. And the book and the blog are intended to be companions. The book is a deep reference which has a lot of information on trade management, probability theory, a lot of the inside nuts and bolts of what drives these trading patterns. And I'm going to keep a kind of ongoing dialogue on the blog looking at these patterns as they evolve in live market data. So hopefully the two will be somewhat useful together. And let's start today looking at the failure test. This is the first pattern that I discussed in the book, and it's a simple pattern on one hand. Look at the chart here on the screen, and this just shows a market trading back and forth between idealized support and resistance levels. And what you see is a market that has popped above resistance here and then has failed. And this entry at A would be a short failure test entry. And then B is the reverse pattern. Market trades briefly below support, and you just have to assume, this is just a schematic diagram, that these are real levels. That's another question to consider. Market drops briefly below support, trades back above, and you would have a long entry here. And chances are that, this A is kind of the ideal, what we would like to see from a trade. Moves quickly away from the entry and would have been profitable, a profitable short. And this trade entry at B is more likely to have been a losing trade, but it's good to see both sides. So as far as the actual entry, the simple entry is a bar that trades above resistance or below support and then closes back inside. So closes below resistance or above support, and you would look to enter short somewhere around this close. Whether you do it actually on the close or you can try for the open of the next bar, though sometimes you'll have gap openings that a good portion of the profit is already eaten up in the gap opening on good trades. But this is the concept that you should have in mind, that you are entering on a reversal after an excursion outside of support or resistance. Also not shown on this diagram but worth considering is that there certainly are cases where the entry comes on the following bar. In other words, where this particular bar might have closed above resistance and then the next bar closed below, and you can take an entry on that second bar. The clean, simple entry is the same bar, but it does not always work out like that, of course. One thing that's very important to consider about trading patterns is we don't just trade simple patterns. It's very important to understand where they fall in the market structure. And I have on the screen here an illustration from the book. This is the same illustration of this idealized alternation between trend and trading range that you've probably seen in every book on technical analysis. And this goes back to Wyckoff's work from the early 1900s. And he basically postulated a four-stage market cycle. That you'd have a market that would go into accumulation, would then go into a markup phase, which is the uptrend. Distribution happens after the uptrend, and distribution rolls over into a markdown or downtrend phase. So, if we could identify this cycle in real time with any degree of reliability, it would be very easy to trade. As you know, it's not very easy to trade, so it's a little bit more difficult than we might expect in some cases, but keep this in mind. And as I go to the next slide, this shows two possibilities for where these failure test trades can occur. Either assume here at the left of the screen that this market is in a trading range. So you have a stock or a commodity or whatever that has poked above resistance in a trading range. You also could have a drop below support for a long entry. Compare that to after this market is in a clear established uptrend. Here you have a counter trend entry. So there's a difference conceptually between an entry in a trading range and an entry in an established trend, which usually for these failure tests is going to be against the trend, a counter trend trade. And on the next slide, I show a further complication. This is something that I want to keep today's presentation fairly simple, but also worth considering that you can have these failure tests that line up with the existing trend. And this is maybe not the clearest example, but if you have this market and an established trend, and then you had a two-legged pullback, or what we'd also call a complex pullback. And this is why I don't want to dig into this too much, because we're putting together the concepts of a pullback with a failure test. It's a little bit more advanced. I'll cover that soon. But you would have a long failure test entry against this pivot, and that would be a with trend entry on a failure test. So there is a third possibility. Usually when we think about these, 9 times out of 10, this is what we're considering. We're either looking at a counter trend entry, counter to an established existing trend, or an entry in a trading range. Just be aware the third possibility does exist. So when you're looking at these trades, we're going to look at a couple examples from market data. Some questions to think about. First of all, how good is the pivot? And by pivot, I mean the previous high or low that you're using to reference to set up the trade. And you don't want this to be some arcane level that only you are aware of. There's no value in this case in some mystery level. You want a level that is visible to everyone. Why? Because you want stops to be there. And that's as simple as I can put it. So, in an uptrend, as the market goes higher and higher, people will be establishing positions against that trend. And where are their stops? Somewhere just outside the trend extreme. If you have an established trading range, then you have stops outside that trading range. And whether they're stops to enter or to exit existing positions, whatever, there is liquidity clustered there, and the liquidity will cluster at visible levels. So that is the key. You want to make sure that your stop levels are visible to every market participant. And as you're looking at a trade setup, you want to make sure that the level was really penetrated, that the market traded significantly through the pivot enough to get the stops. If you're looking at a stock, you probably do not want to enter a $50 stock where the market is traded 2 or 3 cents beyond the previous pivot and then closed back inside. That's not as good as if you're looking at the $50 stock and it traded a point beyond or half a point beyond. If you're looking at the S&P futures intraday, many times a tick, if you're looking at a 5-minute chart, a tick beyond is enough to say the level was really penetrated. Certainly a full point, half a point, even 2 ticks on the E-minis. That's probably a little bit better penetration, but that's the one question you want to keep in mind. However you're defining these pivots, however you're looking for these setups, do you think the level was really penetrated, or was it sort of just bumped up against the level, basically? Another thing to understand is what is the risk in the trade, because we are entering what many times are aggressive counter trend trades. Is the market very gappy? Is there a good chance that you could enter short and see the market gap beyond your stop? It's always possible. So you need to have this in mind too. How am I going to manage that adverse gap opening? Or conversely, how am I going to manage a profitable gap opening? What's my profit taking plan? You can have a bad gap in a market that has not shown a gap in 500 bars. You're much less likely to have a gap intraday, but of course, strange things, news events can happen. But just be aware of the possibility of a gap opening and how you will size these trades. I tend to size them a little bit smaller. I trade all of my trades on consistent risk, but these failure test trades, particularly the counter trend, I will trade them all on reduced risk relative to my with trend trades, just because there's the possibility, actually, there's the near certainty, if you do this long enough, you're going to have a loss that is a whole number multiple of your intended risk. You're going to lose 3 to 5 times, perhaps even more, what you thought you were risking on the trade. And if you're trading an aggressive risk level, that can be a catastrophic loss to the portfolio. Good risk management means, first of all, we avoid catastrophic losses. Is kind of the idea. Also, and last on the slide, you want to have a clear profit-taking plan, and I lay out several possibilities for that in the book. Um, Basically, in general, I'll tend to take a portion of the trade-off at 1 times my initial risk. And sometimes these are very small moves on these trades, and you'll hit that profit level the next day. In terms of stop location, and if you keep in mind, if you're sizing your profit target off of your stop, the stop location is highly significant. There are really 3 possibilities, and probably the most logical would be at the previous extreme. This is a long entry on the screen, and let's just assume for sake of argument that the low of this bar is $50. Let's, whatever market we're looking at, let's just say the low is 50. So the stop at the previous extreme would be a stop order at 50. And another possibility is to put the stop beyond the previous extreme. People will do this many times so they don't get what they'll say ticked out, so they don't get their stops run. But the problem is, you never know how far is far enough. And if you're playing this game of trying to put stops a little bit beyond the previous extreme, one of the dangers is that those may be hit on very good momentum. If your stop is not hit first, the market may be really moving, and you can see some very bad slippage on those. That is, of these 3 possibilities, the one to me that is least logical and most dangerous. Now, the third possibility is to put the pivot inside the previous, I'm sorry, to put the stop inside the extreme. And at first glance, this seems to be kind of stupid. And where I have drawn the arrow would not be an intelligent place for the stop, because you are just sort of randomly picking an arbitrary point. You don't want to risk to here. However, particularly in a thin market where you think you might be slipped, it often can make good sense to put the stop just a few ticks above the previous extreme. So if this is $50 and this is, let's say it's a $5 bar, your stop might go at 50 spot 05 or 50 spot 02 or something like that. Just a few ticks so that your stop is hit first. It's exactly the opposite idea of this guy who's putting his stop somewhere out here, and he may be hit with good momentum. Now, of course, there's always that trade-off with probability. Your stop is more likely to be hit. You will, on some set of these trades, be stopped out of trades that are still valid, and to some extent, that's a little bit of an unavoidable risk. So consider these 3 possibilities, and I think it is somewhat of a personal decision, but you want to be very consistent with how you do this, of course. It's something to think about after you enter these trades. What you should see in the best examples of these trades is that price very quickly moves away from that support or resistance level. This is what we call price rejection, and that's good. On the other hand, consolidation, if the market is able to go dull and quiet near the entry level, that's a bad sign. And you might consider using a time stop on some of these. In other words, if you enter against a resistance level and price doesn't really back off from that resistance level, it's holding up, there's buying pressure up against that resistance level, that's more indicative of the level breaking, and you tend to look for good continuation beyond the level. So in that case, you might want to reduce the position, or perhaps even try to scratch the trade, just get out of the trade. You'll frequently have one or two inside bars. That's okay, but you want to be sensitive to the breakout of those inside bars, because a lot of times you'll have one or two bars that actually turn out to be a lower time frame triangle or consolidation before the trend continues, and then you're swept out. Another thing to consider, which we're really not going to go into in much detail here, is will you re-enter these trades if you're stopped out? There are a good number of these trades that take out your stop and then reverse again on the second day, and it may make sense to re-enter these. This is another reason for trading on reduced risk. You can't take multiple trade entries on full risk without taking too much risk on the trade, if that makes sense. You have 3 entries at full risk, then you're actually taking 3 times the risk on the trade. However, if you were to trade these on half-size risk relative to your other trades, you can have 2 stopped out entries in a row with a normal size trade loss. So keep in mind, as far as action after entry, the basic concept here is in the best trades, we see price rejection. Price moves quickly over the entry level and does not come back. Now, I will say that is somewhat of a meaningless statement, because what I just said is in the best trades, you're going to make a lot of money and you're going to make it quickly. Well, yes, thank you, right? How do you use that for trade management? You don't, but it does have implication for how you read the market and for what you think about the market action going forward. And we'll look at that in one of the examples that I have here. Speaking of examples, let's go over to this is a chart of gold futures. It's continuous gold futures, so these levels are going to be these levels are back adjusted, and if you're referencing actual levels, the prices will not line up, but the action is continuous and consistent. So just to look here, this is a market. Let's assume it actually is in an established uptrend, but let's assume that it is in a trading range. And what you would be looking at here is as the market makes higher highs, you would be looking for a potential entry here, which you do not have. Market makes a new high and backs off, and you do have it would be on the close of this bar, you would have entered short, and you would have been stopped out, you would have been ticked out here, and would have had a re-entry here. So this, even though it is a little bit of a complex example, this is a 2-bar example of a failure test entry. And looking at lows, so the question is, if you assume that this is the established low of the trading range, you will see higher pivot lows. And sometimes people will try to set up trades against these. To me, all of these levels that I'm marking with short lines here, yes, they are pivots, but they are not significant pivots. And it's difficult for me to imagine that there would be much liquidity, many stops clustered beyond these higher pivots. I would be referencing and only looking for a failure test against this most extreme level here. And you do have a long failure test entry, whether you take it on this bar, and this might have been a difficult entry because it looks like it was right on the level. You certainly would have had a failure test entry on this bar. And then notice you have a series of inside bars following, so you are very alert for a downside breakout, and your initial stop clustered somewhere under here. Had we seen much downside momentum out of this little triangle, you would have been able to take a smaller than expected loss. As it is, this market continued higher, and you probably would have had a decent trade setup there. I'm going to page forward. I really don't want to spend a lot of time here going through too many examples, but I do want to point out this is okay, also worth considering. Market is in an uptrend, and you would have been looking, if you would have been looking for a possible long failure test entry against this level, which we did not have, but would have been a possibility after a lengthy consolidation. I would not have been working with any of these other pivots. To me, they're probably not extremely significant in the overall market structure. you may disagree and you may have a different trading plan for those. Here's an example, one of the best examples I've seen in recent market action of a failure test at the highs. And we were able to actually have many of our clients in my research were able to lighten positions based on this failure test, the very high of the uptrend in gold. And it certainly doesn't always work like that, but this is an aggressive counter-trend trade. The market is obviously emotional. Look how ranges have expanded relative to the previous several months. Market has pushed outside the bands, a little bit of a parabolic move, and you are on the 1, 2, third thrust up, and many trends do end with that third up thrust. And let's page forward just a little bit, but I think you're getting the idea here. Another possibility, this is and again, mixing concepts here a little bit, but let's say you had established a short position based on this nice bear flag on the daily chart in gold in December of 2011. You would have had a warning when the market made a failure test at this previous pivot. And some of these best pivots are extremely emotional. And I don't know, so some of you may or may not remember this market, but we had a very sharp sell-off in September 2011. You can see it on the chart. It's part of the beauty of charts, right? If you're not familiar with the market history, it's recorded on the chart. You can see that this was a dramatic extreme which set the low in gold futures for many, many months. And then on this retest, whether you want to reverse long if you had been short based on this bear flag, or whether you just wanted some good information that you just got failure tested, which I don't know, that's exactly correct terminology, but you just had a little failure test around the lows, and that would have warned you to lighten up the short position. So I think that's it. I think you get the idea about the kinds of pivots you want to look at and the kinds of pivots that might be less significant. But these are things to keep in mind as you look at examples of these trades and as you set them up in real time. So there's a couple things to review here. Failure test is a simple and effective counter-trend trading pattern. Be aware that there is a with trend application for this, and we'll cover that in a little more detail when we look at pullbacks. You may want to consider the differences in expectation and risk levels, whether these are entered in trading ranges, counter trend, or with trend. You want to be very clear on what you expect to have happen after trade entry. You want to see price rejection. You do not want to see a lot of consolidation up against the previous extreme. You want to consider the implications on different time frames. A failure test on the daily chart can put in a high that extends for many months or even many years, depending on the emotional nature of the market, where, if you're looking at a 5-minute chart, probably less significant unless it plays into one of those higher time frame turning points. And most importantly, understand the risk of the market you're trading and understand that that risk may not be visible from the chart. You can have a market where volatility expands dramatically, where you have a lot of gaps that are not visible previously on the chart. Just try to always understand as well as possible to quantify and plan for the unexpected risks in the markets you're trading. And always, always, always have a plan. Have a plan for risk management, have a plan for profit taking, for trade management. Always have a plan. And here again is my contact information. If you have any questions, please do feel free to contact me. AdamHGrimes@gmail.com. And if something here sparked your interest, please take a look at the book, which is available on Amazon.com. The Art and Science of Technical Analysis, published by Wiley in June of 2012. Thank you very much.